In their latest release, the Bureau of Economic Analysis announced that third quarter GDP grew at 2.6% rate, better than economists predicted. This growth number was celebrated in some news sources with titles like in New York Times, U.S. economy returned to growth in the third quarter. Others were more cautious with their titles. Business Insider posted an article with a headline reading, "The U.S. economy came back to life this summer, but things are still likely to suck next year." Forbes, on the other hand, was outright pessimistic, publishing this opinion. Why Q3 GDP print doesn't mean recession avoidance? The only saving grace of GDP report was its headline, plus 2.6%. As it turns out, net exports added 2.8 percentage points, and for the wrong reason. Excluding net exports, the domestic economy GDP growth was negative 0.2%. The recession continues. In this video, I'm going to share with you how these economic headwinds affect Bay Area real estate market. This is Michael Tallis with the Tallis team. Watch this video to the end, and if you find this information useful, please support our work by subscribing to this channel, liking this video, and sharing it. Now back to the Forbes article, where they double down on the same point. Lest you succumb to the narrative that this positive GDP print means a recession has been avoided, you should know that it is not uncommon to have a positive GDP quarter within a recession. Here they give an example of 2008 recession and then dot-com bubble, and they finish. We find a similar pattern in the recessions of the 70s and 80s. Given the rest of the incoming data, it is quite clear to us that this recession is continuing. Indeed, what we see here in the Bay Area, that the housing market is slipping deeper into a recession. For the first time since 2019, year-over-year median home sale price in Santa Clara and San Mateo counties declined. October median home sale price dropped by 1.7% compared with the same time of last year. And there are other indicators of the slowing housing market. October sales dropped by a whopping 45% year-over-year, and number of new contracts, a leading indicator of market activity, fell by 47%. And while the number of new listings, the number of homes coming to the market also declined, the number of homes available for sale increased by 27% because homes are coming to the market faster than they sell. The market, however, is still a seller's market. The inventory increased to 2 months from less than 1 month of inventory a year ago. But it was not enough to put buyers in the driver's seat. 3 to 6 months of inventory is considered a balanced market. This sharp drop of the market activity was triggered by the skyrocketing interest rates. If you remember, interest rates were hovering around 3.25% at the beginning of the year. By the end of October, rates more than doubled to close to 7%. Due to their aggressive Fed inflation-fighting moves, it was the fastest rate increase on record and stunned everyone. Both the buyers and the sellers are affected. Most obviously, the growing interest rates affected home affordability for the buyers. Assuming you are buying a median-priced home in the Bay Area, roughly $1.5 million in Santa Clara and San Mateo counties, with 20% down payment, your loan will be $1.2 million. At the beginning of the year, your monthly payment would have been $5,500. But if you are buying this fall, your payment will be $2,700 higher, around $8,200. The increase of the monthly payment will be partially compensated by the declining property prices. Prices fell by 14% in October, compared with April of this year. April was the peak month from the home price point of view in our area. If you're a buyer looking for a new home, talk to your lender to get a custom monthly payment quote and ask them about interest buy-down programs that may help you reduce your borrowing costs. Keep in mind that this home price drop will also be reflected in smaller property tax bill, reducing your overall cost of home ownership. Thanks to Prop 13, these savings will persist for as long as you own your home. Another side effect of the ballooning interest rates is that fewer homes will be coming up for sale. Most of the current homeowners were able to purchase or refinance their homes at rock-bottom interest rates. For them, moving to a new home means that they have to get a new loan at much higher interest rates than their current mortgage. This will discourage discretionary sales when people move up to a bigger home, downsize, or just relocate closer to work. If you're a seller, it is critical more than ever to prepare your home for sale and price it right. Homes get most attention when they just come to the market, the first weekend. That is when most active buyers will notice your home and come over to see it. Understanding the market expectations will allow your home to attract the best buyers and sell fast at highest possible price. Homes are still selling fast. Median time on the market was only 14 days in October. This is Michael Tallis with the Tallis team. If you are thinking about buying or selling a home within next year or even two, call or text me at 650-766-6100 so we can plan your next move together. I am looking forward to connecting with you.